Hi friends and family, Josh Schroeder here with Compass Real Estate in Laguna Beach. I recently came across an article that I found off of nerdwallet.com, and it was written by Barbara Marquand that shared information regarding tax deductions for homeowners. So I know what you're thinking, Josh, you're a few weeks too late. Now I understand that taxes were due April 15th, but it could be beneficial for those of you that filed an extension like myself, or just have this general tax knowledge for next year. Now, this goes without saying, I'm not a tax expert, so please reach out to your accountant for any and all information relating to tax deductions. So you can deduct mortgage interest, property taxes, and other expenses up to specific limits if your itemized deductions on your tax return. You can get some federal tax breaks for owning a home if itemizing deductions on your 2020 tax returns makes financial sense. So here are the deductions. 1. Mortgage interest. This is usually the biggest tax deduction for homeowners who itemize. A portion of every mortgage payment goes towards interest on the loan. You can deduct the interest you paid up to a limit, which depends on when you took out the mortgage. So December 16, 2017 and later, you can deduct the interest of up to $750,000 or mortgage debt, or up to $375,000 if you are married and filing separately. Now, October 14th, 1987 through December 15th, 2017, you can deduct the interest on up to $1 million of mortgage debt, $500,000 if married and filing separately. Now, if you refinance the mortgage, the limit depends on the old loan's origination date. If the mortgage predates October 14th, 1987, all the mortgage interest may be deductible. So your mortgage servicer will send a statement each year showing how much interest you paid. Home equity loan interest. Interest on home equity loans and home equity lines of credit can be deducted, but only if you spent the borrowed money on home improvements. Before the 2017 tax reform law went into effect in 2018, you could actually deduct the interest even if you use the money for other purposes, such as college tuition. But your home equity loan or HELOC debt counts towards the total mortgage debt limit for deducting the interest. So, if your first mortgage is over the deductible limit, then the home equity loan interest won't be deductible. Discount points. So if you're within the limit to deduct all your mortgage interest, you may also be able to deduct discount points you paid when the mortgage closed. Some homeowners buy discount points to lower the mortgage interest rate. One discount point costs 1% of the mortgage amount. The term points can be confusing because some lenders call their fees loan origination points. Those points go towards paying the lender's costs for providing the loan, and they are not tax deductible. Only discount points paid to reduce the interest rate can be deducted. Property taxes. Now, you can get a tax break for paying property taxes, but there's a limit. You may deduct up to $10,000, well, $5,000 if married and filing separately, of property taxes in combination with state and local income taxes or sales taxes. Home office expenses. You may deduct home office expenses if you're self-employed and use part of your home regularly and exclusively for your business. You can use the IRS simplified method or your actual expenses to figure out the deduction amount for home office expenses. Medically necessary home improvements. Now, when figuring out your medical expense deductions, you can include the cost of installing healthcare equipment or other medically necessary home improvements that benefit you, your spouse, or dependent. Permanent improvements that increase your home's value are only partly deductible. The deductible cost is reduced by the amount of the property value increase. Now, many improvements to make a home more accessible, such as, let's say, constructing entrance ramps, widening doorways, railings, etc., usually don't increase the value of a home and can be fully deducted. Now, there's mortgage insurance premiums. The cost of mortgage insurance is currently deductible. The deduction includes the amount paid for private mortgage insurance for conventional loans and mortgage insurance for FHA loans. It also includes a guarantee fee for USDA home loans and the VA funding fee for VA mortgages. The amount you paid for mortgage insurance is treated as mortgage interest. That's what the IRS says. So the mortgage insurance deduction had expired at the end of 2017, but Congress extended it to include premiums paid through the end of 2020. Homeowner costs that are not tax deductible. So here's a roundup of expense homeowners you guys can't deduct. home insurance premiums, transfer taxes or stamp taxes, cost of utilities, rent for living in the home before closing, costs for getting or refinancing a mortgage, such as loan assumption, credit report, and appraisal fees, depreciation, forfeited deposits, down payments or earnest money, wages for domestic help. So that does it. If you have any other questions or comments, please feel free to message me directly or leave a comment below if you're watching this on YouTube. Much love. Have a great rest of your year, and I look forward to talking and meeting up with you all soon. Take care.